Hi, Sean.
Hi.
We have Sean Wang with us, who's an accounting professor at SMU Cox School of Business, and we're here to talk about his research, information from implied volatility, co-movements, and insider trades. And we've talked about this before, I don't know, probably a year and a half ago or so. And you've updated your paper, and obviously there's a lot of volatility. Things have changed quite a bit. I mean, can you just kind of, maybe discuss a little in what way you've updated the research since we last talked?
Sure. And actually, let me just, sort of give a recap of what the original thesis was,
Right.
With regards to this particular idea. You know, traditional research has sort of looked for measures of bellwetherness within firms, and when I talk about that, I'm talking about specifically firms that attempt to act as a as a microcosm of the macroeconomy itself. And so in general we see things like firms on the Dow 30 or something like that, but there's never really been a really well documented measure of bellwetherness per se. The majority of people use size. Large firms tend to proxy for the economy. Of course, you could argue that's somewhat mechanical. Looking at FANGs, for instance, at least, maybe that's lessening to some extent. But previously, you could take the top 5 or 6 firms that tended to all be big tech, and you had 27% of the market cap or whatnot. But there was no real way to sort of have some theoretical grounding in measuring these type of bellwethers. And there are our story looks at volatilities, because volatilities represent information shocks to the market.
Right.
And traditional literature has also looked at volatility in that same vein, but the majority of the prior literature until recent years has used realized volatilities, which is volatilities from actual stock returns. And this deviates from that just a little bit by using implied volatilities, which are the volatilities that come from option traders' beliefs about future incoming information.
Yeah. And go ahead.
So I was going to say, the advantage to our measure, theoretically, is, there's been a significant amount of research that show that option trading investors are coming from sort of an informed advantage, or tend to be better traders than equity traders that are oftentimes passively investing or noise trading, for instance. And so our approach is to identify these bellwethers by taking firms whose volatility, their individual level volatility, co-moves or correlates with the volatility of the actual market itself.
Right.
And we use implied volatilities. They're forward-looking, and look at the correlations of those two.
One thing, just for definitional purposes, so what, just in layman's terms, what is options trading capturing, just in a simple way, just so that we're, discussing?
So, sure, absolutely. So the layman's view of this is, an option is a contract that gives the holder of the option the ability to buy a share of the stock, or to sell a share of the stock at a given price at a given time. And to make a long story short, the asset pricing literature has come up with a model, which we now know as Black-Scholes model, that allows for the pricing of options based on a host of different variables. And essentially those models attempt to determine the price or the value of that option based on multiple other variables, one of which is implied volatility, i.e., this is investors' beliefs about incoming information. So what we do is we look at prices as a given because the options are being traded on the open market, and then we back out beliefs from the investors to capture those implied volatilities. We use this as a proxy for what they.
Right. I mean, and I guess what I'm really asking in a really simple way, as opposed to mechanics, just options trading captures what sophisticated investors believe.
That's the idea. Yeah.
Okay, that's the simple. Okay, so that's yeah, they're kind of like, options trading is a proxy for the insider, for the smart investors outlook kind of thing. And
correct.
And then the other thing too with your model, I mean, what you've done, your IVC, your implied volatility movement, would you call that a metric, or do you refer to all this as a model, just so I can refer to it properly?
I mean, I think it's more of a metric. I mean,
Okay.
we have a model, but it's
Yeah.
not a very sophisticated model. It's more
Right.
just
Okay.
a catch-all statistic type of
Yeah,
variable.
because I mean, when I'm talking to you, I'll just say the metric, right? The IVC metric or whatever. So the other thing I was going to ask you about, just to set the, tone also, is I know that you also, this hinges on earnings and growth, what your paper, studies. Can you talk just a little bit about what the IVC and earnings news, what that relation is a little bit, and then we'll get into some applied stuff and look at these charts. So
sure. And again, so this measure, again, this IVC measure is essentially the correlation of incoming expected information from firms and how that correlates with incoming information from markets. Basic idea is, when the incoming information sort of zigs and zags together, this firm is believed to be by markets sort of very similar in the way the economics of the firm runs versus the market. So with regard to the test that you were speaking of, if our theory holds true that these firms with high correlations are microcosms of the market, we would expect to see something like, when those firms announce earnings, the news in those earnings, which oftentimes tends to be considered firm-specific or idiosyncratic news, in that it's related to the firm in general, shouldn't move the market that much necessarily, unless they happen to be these bellwether type of firms.
right.
And what we show is firms with high levels of IVC tend to move the market significantly more than firms with low IVC.
Yeah, funny enough, you should say that, because I know that Disney is one of your high IVC firms, and yet, when they replaced the CEO, I think it was yesterday or the day before, I mean, it was lots of market movement. I mean, yes, it was perceived as positive news, right, by the market, but maybe owing to the fact that does have high IVC, it is one of those stocks that is it's a microcosm of the macrocosm effect that you're discussing. I wonder if that had an extra kick to the volatility that we saw relative to that announcement. Do you think that weighed in because because it is a bellwether and it has high IVC?
So my take on the whole Disney transition, I didn't see maybe as much movement. I didn't follow the market that closely yesterday with everything that's going on, but Disney is not the only firm with this unique position of having massive rise during the pandemic. And since they're consumer discretionary, they are facing all sorts of issues with rising costs and inflation. And so they're trying to trying to figure out how to pivot in all of this, and so they've chosen to replace their CEO, and they're not the only firm, as you know very well, changing out human capital right now, and we're seeing mass layoffs all the way across the board. And the fact that Disney went out and made that specific CEO change, I mean, that is a volatile event. The market did see it as positive on average. I don't remember what I saw, maybe 6.5% for something like that yesterday. But the market sees that as volatile, and clearly a sign that we're going to see lots of shifts in labor markets, like we've seen at Meta. Musk sort of deloading half of the staff at Twitter, and Amazon preparing for mass layoffs. So it's a pretty brutal time right now with regards to trying to run these firms.
Right, I know, and that kind of gets to, I mean, I had a question. I mean, we'll just hop into this and then we'll look at your charts in a minute. Chevron was, actually number 5 in your research before in terms of the top ranked bellwethers. And now it's moved 4, which makes sense because, and I know this was run to like 2019 or something, because now we have this flip, right, between in the last year or so, energy stocks represented, by XLE and USO versus the triple Q, and because all that, the interest is flipped. And so it's interesting because your model started picking up the change in Chevron, energy being, more linked to the macroeconomy, even because back at its low point, the big oil and gas stocks they got down to like 3% of the S&P, whereas they used to be 12%, and a lot of things happened to make that change, but now they're rising again, and now they're like back to 5% of the S&P, that's going up. And then you have, like you said, the tech stocks are going the other way, so you have this flip, and it's a super volatile time. And so, I mean, from your research, what would you say about this dynamic with tech stocks? And you mentioned the human capital idea, and I know that's some other research we discussed, this intangible value issue. I mean, kind of what are your thoughts related to, the bellwethers, changing bellwethers, changing priorities, intangible capital? I mean, that's a lot I just said, but
Yeah. Well, I'll digest it all and sort of give my thoughts on state of the market, as it is of today. And maybe a decade or even less than now, we'll all see the sort of the bubble that happened, which appears to be the case during pandemic times. And hindsight is always 2020, right?
Mm-hmm. Yeah.
And we're going to look back and say, man, it seems so obvious. Fed uses monetary policy to cut interest rates to 0, and everyone's sitting at home, not with their jobs, and then all of a sudden, lots of poor young, relatively, poor young people all of a sudden are endowed with these government stipend payments with nothing to do. They can't go out and even use them on normal goods and services. So you see people getting entertainment from things like Bitcoin and meme stocks.
Yeah.
And
Yeah.
so, and the other thing to just sort of speak to specifically is when you think about valuation in the form of the standard DCF model, right? I mean, the denominator of that model is the cost of equity capital, which is a function of the risk-free rate and some risk premium. Well, guess what? If you cut the risk-free rate to 0, like if you think about as you move towards the terminal value in a DCF, that value is getting discounted exponentially, right? And so if the cost of equity, let's say, is 8%, and the cash flow is 10 years out. You're discounting the cash flow by 1.08 to the power of 10, right? Which is not 1.8 times 10, and people fail to understand how this sort of exponential growth really impacts us so much. But the point is, if you take that 1.08 and you cut it to 1.03, the value of growth firms disproportionately will blow up from cutting those interest rates. That's what we saw. Because a way to put it differently is, if the interest rate was truly zero, investors would be totally neutral on making the money in year one or making the money in year 20, because the opportunity cost is zero, right? And that's what happened. So all these firms, tech firms, who tend to have cash flows expectations far out in the future, i.e. being high tech, all of a sudden had massive value, right? And not to mention the fact that, when you shut down the economy completely and flip that switch, energy, needs go to a standstill, right? So we saw this flip where energy became dropping out to the bottom, and then there was also this EV type of stuff, that thinking that we're going to obviate ourselves from the need. We know that's not the case just yet, but so tech was all the way up here, energy was down here, and then now, the economy has started to flip the switch, started to come back on, vaccine came through, and the Fed has to ease on that monetary policy, start buying, selling those bonds, and then, raising the interest rates. So when you raise those interest rates, those lofty valuations on tech firms are going to rationally come down as well.
Right.
And then, of course, energy has gone through the roof with the war in Ukraine and everything like that, cutting off some supply. So massive volatility, right?
Right. Well, and also back to the energy story, this is something I learned in the Fed presentation I was just at. I mean, we knew oil prices have gotten higher than they were, obviously. Natural gas prices are higher, and other commodities, minerals, connected to the energy transition are high. All of these high price commodities were happening before the Ukraine war, because of, as you say, when you flip the switch to get the economies going again post-pandemic, you're just all that demand, and then supply, there's inelasticity that's working in all this. And now, and then Ukraine happens February 24th or 25th here, because I was watching the timeline on all that. And, that's just heightened the volatility. And then now some of the story is, like you said, now you lay on interest rate rises. So you're coming out of a pandemic, you have a war that turns everything upside down, redraws maps. And then interest rates rise because of all that pent up demand and everything. It's just, it's a crazy recipe, right? I mean, it's insane. We can look a little bit at real quick, take a peek at your these charts related to your research, and then we can hop back in and discuss anything that needs to be discussed. Let me just see here what we've got going on. Okay, so I was just looking at so the bottom one is your old research, and the top is the newer research where you've run the model again, to 2019. And it seems like to me that that the aggregate market returns, they do, of course, track your fit, which is the
blue line on the top. Yep.
Hang on. Yeah, here's your prediction. Yeah, the blue line, and then the actual market is this one, and obviously there's more movement. It overshoots and undershoots, but yours is smoothing that trajectory. So is it that the market itself is more volatile, or is that momentum because that's the way the world works? Or how would you describe that disparity,
Sure.
a little
Well,
bit?
I'll tell you one thing for sure, which is that when we wrote this paper, it was sort of very much a conjecture as to whether or not we could do something. We knew that the thought of implied volatility co-movements between the firm and the market was potentially a very interesting type of measure, but we wouldn't have necessarily, taking insider trades and trying to predict aggregate equity markets is not a very easy thing to do.
No, it's
Um,
it's like rocket science of
so
finance, right?
yeah, so we didn't really have any sort of ex ante predictions on overreaction or underreactions. The predictions we mostly had was, is this really going to give us a decent measure on which firms are sort of the pulse of the economy, and how well would it actually work versus things like size or realized volatility or beta or something like that. And but it does look like there's some sort of overshooting, which is consistent with um, a lot of the asset pricing literature done in academic finance, where we tend to see sort of long-term reversals to news. So there's a significant amount of literature that looks at sort of short-term momentum followed by long-term reversals. And so if we're seeing that in this pattern, and again, we haven't formally tested it econometrically yet, but sort of eyeballing it might suggest that's the case. That would certainly fit into that pattern, right? So we know, for instance, that if you buy a pile of high momentum firms and hold them for 90 days on average, you tend to make money. If you do this, continue to rebalance over decades and decades, that's what the data showed us. But we also know that you lose in the long run. And I think our data, or at least your conjecture, is sort of consistent with what we've seen.
Right. Yeah, the long run. Yeah, exactly, over the long run. And that actually, there was some research I profiled a few months back that was sort of that story. Just looking quickly here at some of these bellwether firms, and this is from your 2021 paper, and JP Morgan Chase, Citigroup, Disney, Goldman Sachs, Chevron, Home Depot, Visa, Apple. Apple's like, I think, number 8 or something like that. My one question I had, so this was run in your 2021 paper, and then in your newer paper, Apple actually went up 1, I think, and Chevron went up 1. This takes us through 2019, your model run. Any idea why? I mean, they're not significant moves, but any idea why they changed in their rankings?
Okay, so first of all, these are, so I meant to respond to an email to you about this comment, but the changes that you see in this particular example are slight fluctuations resulting as the change in the model. These aren't
Right.
these are both end of year 2015. They're not updated to the more recent year to reflect changes in the economy. Now, my co-author has updated this. I haven't spoken with him for a few months, but we've looked at how things have moved through towards the pandemic, and at the time, I believe that we did see that tech firms pumped up a little bit more, and then we haven't run it since with the 2021 data. But the models changed slightly as a result of the review process where the paper is at currently.
Yeah.
And you had asked about that. And one of the things was that, and again, I don't want to get too technical about it, but
Right. Yeah.
the old version basically looked at implied volatilities or implied standard deviations with co-movements with the market, and the new version looks at implied variances. So the only difference is essentially the square root, but it's creating some slight fluctuations in the definition of the bellwethers, which is primarily what you're seeing across these two things. When I get an updated, when we get back on this project, which should happen in the spring of 23, we'll update the data again, and I'll be happy to send you what the latest version of how the market looks today, because I do believe that the time series of this stuff is potentially interesting to other people.
Oh yeah, I mean, I'll stop sharing.
Sure.
Yeah, for sure. I mean, it's going to be very revealing. I mean, if you had to guess in terms of how, which bellwethers change, how they change, I mean, what would you think given your work in this area?
I mean, I would guess that, during the middle of the pandemic, I mean, so again, just to backtrack again, since whoever may be watching this probably hasn't read, the paper in full detail, one of the advantages of our bellwether method is that it's more dynamic, and things like size,
Right.
in general, tend to be rather sticky over time, or things like the Dow Jones 30, using those as bellwethers, because those are sort of an arbitrary, there's no official sort of way that these firms are actually chosen, whereas ours actually have a methodology and a theory behind it. But basically, one potential advantage of using these IVCs is that they move with the pulse of the market. And so, again, if I were to look at this in later data, the expectations would have been, leaders that are sort of cloud driven and things of that nature would have really taken center stage slightly following the pandemic. And my guess is even, firms that were sort of biotech firms were probably, if you were making the vaccine, there was a lot of hedge fund money reading all of your clinical trials and guess who was going to come out with the leader. And I remember looking at New York Times data and following this stuff and talking with my friends who are medical experts in the field. We were trying to guess too, just like analysts. Of course, I trade on my own money, outside of my job as a professor. But
right.
So I would expect that we would see some healthcare that was in there as well, because those were the times of what was really, really relevant in the midst of that pandemic.
Yeah.
With oil doing less of that total economy, where things have really flipped these days, and consumer discretionary as well, being a major pulse of the economy with inflation changing and all of this going on.
Yeah. Yeah. Well, and now, I mean, the energy sector is having very good returns, and a lot of these top energy firms, integrated firms, and Permian focused firms are not going to be going back to capital markets for a while. Their balance sheets are cleaned up. They're in good shape. And so, and then on top of that, the energy transition, and, there was a lot of all that, green interest, let's call it, that pushed up prices along with tech.
Yep.
Now all that's come crashing down to an extent. And what's sticking is what's more fundamental, as opposed to, like you say, the growth expectations, I guess, are being tempered with not only normal tech, the FANGs, but everything connected to this energy transition, that's tech, that's growth. It's going to have a haircut too, right?
I mean, just look at companies like Plug Power, right? And look at what happened to them from the height of the peak, which is probably November 21st or whatnot, to where we are now. I mean, that's, these types of alternative energy sources that had essentially real cash flow expectations way out on the horizon, at 10-year horizons, is when profitability really kicks in. People will give you a pass on that when the Fed funds rate is 25 basis points, but if you bump that up by several points, it becomes a whole different ballgame.
Right. Yeah, it's a really interesting time, and younger people, younger investors forget because they've never been in a world where interest rates were higher. How did it look? Shoot, pre-financial crisis. That's 15 years ago. Pretty much. That's that's practically a generation, that hasn't even seen higher interest rates. I can remember writing about, Greenspan this, and I forget the one that was during Bernanke, and discussing monetary policy and this and that, and these changes. And I wasn't really relating it to the stock market because I wasn't into it at that point. But yeah, so it's a whole, having some history. I get on these investor calls with these guys that are like in their 70s, and they've seen it all, and these guys are quants, and they're really good, and they've been in investment houses, and they'll show all their charts and everything and what they see, and they have like 4 decades of knowledge and trading experience. And it's pretty cool to sit with them, because they're loving it now, because they're like, yeah, they've seen this movie, where, we're just trying to, oh, wait, this is how the world works, right? For real, when money costs something,
Sure. I mean, I think we're going to look back in history, and we're gonna say, well, gee, that just seems so obvious, and we're gonna look at it and say, well, if you connect that to a standard valuation model, then obviously money that's far, far away isn't really getting discounted very much. So, when you never actually have to realize the cash flows, so you just say that they're going to happen, you tell a nice story and you say they're going to happen 10 or 20 years down the line, then you change the story later. Not to date myself or whatnot, but we had this when the dot-com boom came, right?
Right.
People just temporarily didn't care about cash flows that were way down the line. So there was all this VC money, and people that changed the name of their firm and put .com on the end of it got a 50% bonus on their market cap. I mean, who the hell wouldn't want to do that?
Yeah. So. No, it's like we lose our minds for for periods of time, and we get all, mesmerized and infatuated with innovation and technology, and it's great, and and social media does all that for us too, right? So it's a whole new world. Just switching over just really quickly, anything that comes to mind. I mean, we're not going to get in the weeds at all about the intangible capital research, but just the idea of, there was all this intangible capital being built into tech firm, valuations, which is getting sliced, like by, I don't even, is it a third? Is it 40% now? I quit keeping up, What would your research, or what would you say relative to that dynamic?
It's, when I look at markets these days, and having traded more frequently with the volatility in the last 24 months, I would say, we're still sort of in that shaking out period to where we realize, or where the market is trying to equilibrate, whether or not we've gone too far in the correction of not just big tech, but pandemic tech. Good Lord, right? I mean, if you want to think about overshooting one way, Zoom probably never should have sat at 500 times PE or whatever it was. But looking yesterday, I see it at 23 times PE, or 25, which is roughly in line with that of the entire S&P 500. Do I really think that like Zoom is going to have less growth than the average firm on the S&P 500? I do think that hybrid workplace is sort of the wave of the future, and Zoom isn't really going anywhere in the long run. If anything, it has opportunities. So there is a lot of, in some sense, what you're talking about, the valuations getting slashed, a lot of intangible capital sort of getting erased. Some of that is a function of the Fed's monetary policy and raising interest rates, as we just talked about. But a lot of it is real too. When I think about this, I think about, capital budgeting decisions can actually change as a function of this shock to the monetary policy. So you imagine, like I said, you raise up interest rates, cash flows. If you think about DCF projects and trying to pick projects with positive PV, if the interest rate is zero, the project selection is totally different.
Yeah.
So, let's look at Meta. It's gotten destroyed in the last 12 to 18 months. Well, they come out with earnings announcement news, and everyone's all of a sudden so damn concerned that costs are too high. These costs are R&D costs. These aren't really expenses in the sense that they should have some bearing to expected future cash flows. Nobody would have cared if the interest rate was still zero, because as long as you're going to get something eventually in the long run, people are cool with it. But now all of a sudden, we're at these, pie-high interest rates, the highest since the financial crisis, and everyone's like, "Hey, why'd you cut your ad business to do this kooky stuff with glasses?"
Yeah, I know. Well, I know. I was about to say, yeah. I mean, okay, it's virtual reality is so not a priority right now when you've got energy security issues, food insecurity issues, rising cost of projects, inflation, all sorts of volatility. Yeah. Staying on that virtual reality train is just, it defies logic.
And you know what? Maybe 24 months ago, it didn't, when Facebook was trading at 389 versus 100 right now, or 75 or whatever it is.
Right.
And, it's not to say that isn't the future, but the market passed on it for now and said, we don't like that idea.
Right.
And we saw massive layoffs as a result. So, with regards to the whole intangible capital story, when they're laying those people off and they've spent years training them or having them, build this system of essentially knowledge capital and organizational capital. Yeah. When you have these massive layoffs, you're punting on those people. You're not getting that investment back.
Right. Yeah, because they're going to go do other things, and they're going to take that knowledge and that innovation and apply it elsewhere. Maybe they're going to apply it to something where it will be more readily used. And, like you said, punt the football on VR for another day, when we're in a whole different, landscape. But, we are where we are, and a lot of things have happened on the planet, a pandemic, a war, we realize that, our resources, we've got to be smart and efficient about our resources, whether it's natural capital or human capital, and, frankly, this was coming, this rise in interest rates. The necessity of making money cost something, had to happen. You can't just print money. You can't just, give it no value. And, anyway.
Well, the other passing thought just to think about is how much we've seen crypto and all those things fall out as a result of this. I mean, again, you infuse people with free money during the pandemic when people have nothing to do and are just bored out of their mind. TikTok becomes ridiculously popular because there's nothing to do. And you've got these people with, crypto, when you don't understand fundamental valuation, you don't really understand the difference between the safety net on holding something like Apple, which has massive revenue and intangible assets, or Exxon, which has massive real world assets, versus crypto, which the value of that asset is what you can sell it to, or the investor that you can sell it to on any given day.
Right.
And so, you know, people are just buying crypto because they've just been endowed with free wealth, and let's take a gamble in some sense, knowing full well it's a lotto. But then all of a sudden, when money comes back into focus and it's hard to make ends meet, you know, we're seeing far less of that excitement for high risk on assets like Bitcoin and Ethereum and all of that.
Right. No, that's great. Are there any, you know, last summary remarks on your IVC, you know, volatility? I mean, just in terms of, you know, what you think your measure will, you know, help in the future or now for others to understand about the way the world works?
I think one thing that we plan on doing as we update this this working paper going forward is we'll probably try to do a little bit more analysis on how things have evolved during the time series. The other thing that we thought it was potentially interesting was there's no reason why we couldn't to do this at the industry level. So right now we look at the firm's IVC with that of the macro economy to figure out which ones are sort of the macro leaders.
Right.
There's no reason why you couldn't do that within each pharma French sector or gig sector or whatnot.
Yeah.
And you could figure out whether or not the investments that, let's say, Apple was making was driving tech more than the ones from Netflix, for instance, or whatnot. And we should see some dynamic movement in that as well. So there's a chance that we can use this in the future to sort of study how, you know, competitive advantages sort of erode and evolve over time, as we've always seen, you know, looking at market leaders change from the GEs of the world and US Steel before that, going to energy, going to tech, you know, as we sort of stand today. So we can try to extend this basic line of thought, which is the correlation of these implied volatilities, and to try to look at them in other applications to hopefully see if this measure has juice outside of just this setting.
Yeah, I would think, you know, the energy sector could be really interesting too, because there is so much dynamic movement in it now with the energy transition. And, you know, a lot of the big oil companies are becoming big energy companies, and starting to spend capital, you know, to do more low carbon initiatives, whatever their competency is. So you might see, so it'd be kind of interesting, you might see some differentiation, you know, with their strategies and with their bellwether status over time. That's just starting to happen, you know, over the last, well, several years. I mean, there's been firms that moved faster, like Shell and BP. US firms a little lagging on some of that because they're being cautious, you know, and we know with what's happened in Europe, you know, some of them got their, their strategies are, you know, we're still, jury's out, you know, on some things, but yeah, no, that'd be great, having a sector focused IVC bellwether, you know, look.
Yeah. And I think we are excited to sort of embark upon that. I think and we haven't, you know, I don't want to get into the weeds of all the sort of methodology behind it, but one potential hurdle that we may face is sort of like when you look at those option prices and try and extract them, a lot of times there's potentially less liquidity in some of the firms that aren't quite as large. And so, you know, when the option prices are less liquid, then the IVC measure has sort of more noise to it as well, and may not work as well. So it's sort of a balancing act econometrically on what we end up with. Obviously, when you run it with the full economy, it's less likely to be an issue. But if you look at one small sector where the options are less frequently traded, for instance, then some of those IVCs might have additional noise to them. But anyways, we're excited about trying to extend it. The other thought was whether or not managers within the industry could potentially look at their competitors' IVCs and how they've changed over time to say, hey, look, Exxon decided to make these investments, or let's say BP decided they were going to go green, transition from sort of brown to greenish energy or whatnot.
Right.
How does the market perceive their investments? Do they now track better with the market because that's what the market is believing is going on? Or is the market sort of saying, hey, we're not really sure what you're doing is really the wave of the future? And to sort of look at that from a strategic standpoint internally would be potential use as well.
Oh, yeah. I mean, that would be very, very interesting, because I can actually intuitively see what you're talking about, just because I track that in my own mind, watching what's happening on the ground, and how the market's responding and how things are changing. And yeah, it's very dynamic and rich. Well, thank you. I'm going to stop recording. Thank you for your time and explaining all this really very cool research, and look forward to talking again in the future.
Always a pleasure. Thank you.